Cell 1. In this cell, we're developing a projected gradient descent PGD portfolio optimizer that incorporates a selection mechanism to determine which stocks to hold. This enhancement is crucial because optimizing a portfolio isn't solely about maximizing returns. It's also about selecting the right stocks to achieve the best performance while managing risk. Let's delve into the different approaches we can take for stock selection. One effective strategy is the two-stage method, where we first rank the stocks based on performance or some other metric. Once we have the rankings, we can select the top K stocks, after which we proceed to optimize the weights of this chosen subset. This method is recommended due to its systematic approach, allowing for clear and logical decision-making based on performance indicators. Another approach is to impose a hard top K constraint within the optimizer itself. In this case, after each optimization step, we only retain the weights associated with the top K stocks. This technique is straightforward and has proven to work effectively in practice. It simplifies the decision-making process, ensuring that only the most promising stocks contribute to the final portfolio. Lastly, we have the soft sparsity option, which utilizes techniques like L1 regularization or entropy penalties. This method encourages fewer stocks in the portfolio, but does not guarantee that we will end up with exactly K stocks. While it allows for greater flexibility, users must be cautious about how this flexibility impacts the overall performance. As we move forward to the next cell, we'll likely implement one of these strategies into our optimizer. This will pave the way for a more targeted and efficient portfolio management approach, aligning our investment goals with the selected stock dynamics. Cell 2. In this cell, we're setting the stage for analyzing stock performance by downloading historical closing prices for the Dow 30 companies, which are crucial for understanding market trends and making informed investment decisions. This process involves a few key steps, including fetching the data, computing daily percentage returns, and preparing the data structure for subsequent analysis. We start by importing necessary libraries, such as yFinance for financial data retrieval and Pandas for data manipulation. Additionally, we take some precautions by configuring Pandas to display all columns, rows, and their content without truncation. This is particularly useful because financial datasets can sometimes be extensive, and seeing everything at once can help in our understanding. Next, we define our list of Dow 30 companies. These tickers represent some of the largest and most prominent firms in the US economy, which makes them ideal for our analysis. Once we have our list, we use yFinance to download the closing prices starting from January 1st, 2020. The data is filtered to retain just the close prices, and any rows with missing data are discarded. To gain insights into the stock returns, we calculate the daily percentage change using the PCT change method. This transformation of price data into percentage returns allows us to observe the relative changes in stock values over time. After dropping any missing values from this new dataset, we store the index of dates and the names of our stock tickers for easy reference later. Transitioning to the structure of our data, we convert our returns data frame into a NumPy array, optimized for performance in further calculations. We also capture the dimensions of this array, which tells us the number of time periods and stocks involved in our analysis. Finally, we print the shape of the returns data and display the last few entries, ensuring we can see immediately how our data looks at a glance. This setup is crucial as it allows for subsequent analysis, particularly in understanding correlations or building models around these stock movements. In the next cell, we'll likely delve deeper into that analysis, exploring how different stocks interact with one another in terms of their daily returns. Cell 3. In this cell, we are setting up the foundational elements needed to build our investment strategy, specifically focusing on estimating expected returns and covariance from our daily returns data. This step is essential as it allows us to understand the potential performance and risk associated with our selected assets over a specified period, helping us to optimize our portfolio effectively. We begin by defining a few key parameters. Firstly, we're establishing our look-back period at 252 days, which represents roughly a full trading year. This time frame is critical because it provides enough data to capture the trends and behaviors of the assets we're analyzing. The rebalance frequency is set to monthly, meaning we will adjust our portfolio each month based on the information from the previous month's performance. We also specify the number of stocks to hold, in this case, 10, which allows us to diversify our portfolio while maintaining a manageable level of complexity. Further, we introduce a return versus risk trade-off parameter, labeled as lambda, set at 8.0. This will help us balance our desire for higher returns against the risks we're willing to accept. The learning rate of 0.2 and the maximum number of iterations at 2,000 are put in place to guide our optimization process, ensuring that we can fine-tune our strategy effectively without excessive computation time. We then generate a list of rebalancing dates, taking the last trading day of each month to determine when to adjust our portfolio positions. This step ensures that we only consider actual trading days, enhancing the accuracy of our strategy. By focusing on these inputs and structure, we're setting ourselves up for a robust analysis. As we move to the next cell, we will delve deeper into computing the expected returns and covariance matrix, which will be pivotal in making informed investment decisions. Cell 4. In this cell, we're diving into two pivotal functions that help convert optimized weights into holdings that meet specific conditions. Understanding these projections is essential for ensuring our results adhere to constraints like non-negativity and unit sum, which are frequently encountered in optimization problems related to portfolio management and resource allocation. The first function, project to simplex, takes a vector and projects it onto a geometric shape known as the simplex. This is crucial because it ensures that all the weights are non-negative and sum up to 1, reflecting realistic constraints in many applications. The workflow starts by sorting the values and computing their cumulative sum, which helps identify a threshold. Here, we use the rank of each item to find how many entries can be included without surpassing the value of 1. This results in the optimized weights by filtering out any negative projections, ensuring all elements remain valid. Next, we have the Project Top K Simplex function. This function adds an extra layer of complexity by imposing a restriction. It ensures that only the top k values from the input vector are non-zero. If k is greater than or equal to the size of the vector, it simply calls the previously defined project to simplex. Otherwise, it identifies the indices of the top k values, projects them onto the simplex, and sets all other values to 0. This function is particularly powerful when we need to enforce sparsity, essentially helping to focus resources on the most critical components. It's important to note that while this approach offers great flexibility, it assumes that k is a valid positive integer and that the input vector has enough values to select from. One potential pitfall is not accounting for cases where k exceeds the length of the input, although the code handles that scenario well by reverting to the standard projection. Looking forward, the next cell will likely build on these projection techniques to delve deeper into how they can be utilized in strategy optimization, offering insights into achieving better performance metrics or returns. By leveraging these functions, we can develop more sophisticated models that adhere to practical constraints while delivering optimal solutions. Cell 5. This section of the notebook introduces a custom optimizer designed to manage a portfolio with specific constraints, focusing on the top K holdings. The projected gradient descent with top K method not only helps ensure that the portfolio remains long-only and fully invested, but also limits the number of assets to a manageable handful, making it particularly useful for investors who want to maintain a concentrated strategy. At the heart of the function is the need to calculate optimal weights for the portfolio based on expected returns and the covariance of asset returns. Initially, it sets an equal starting weight for each asset, then applies a projection to ensure that the solution adheres to the top K constraint. This is essential because we don't want a bloated portfolio. Instead, we focus on maximizing potential within a limited scope. As the optimizer iteratively adjusts the weights, it calculates the gradient, which provides a direction for modifying the weights to enhance returns while minimizing risk. This is where you see the significance of factors like expected returns, represented by mu, and the risk associated with asset correlations, captured in sigma. Every iteration refines these weights based on a learning rate and the gradients computed at that step, ensuring a balance between exploration and exploitation. One of the important considerations here is the tolerance level. If the change in loss function falls below that threshold, the algorithm halts, reflecting that further iterations are unlikely to yield significant improvements. This built-in check helps to conserve computational resources and time, making the optimization process more efficient. As we move forward, the next section will likely apply these optimized weights in a real-world scenario, analyzing the potential performance of this constrained portfolio strategy against a benchmark or alternative strategies. This progression will deepen our understanding of practical applications, shedding light on the potential benefits and drawbacks of using such focused asset selections. Cell 6. In this cell, we're performing a rolling backtest of an investment strategy where we select holdings at the beginning of each month and maintain those positions throughout the month. This approach is critical because it allows us to evaluate how well our selection of assets and adjustments to weights are performing over time, giving us insights into potential returns and risk. The logic begins with initializing two lists to hold our weights and returns over time. Then we loop through each date in our rebalancing schedule. During each iteration, we first determine if we have enough historical data to calculate meaningful statistics. If not, we skip that date. If we do have sufficient data, we extract a look-back window of returns, which helps us to estimate expected future returns and the covariance of asset returns. These two metrics are vital for understanding how the assets interact with one another. Next, we use a function to optimize the weights based on these expected returns and the covariance matrix, targeting a specified number of top holdings. This optimization process is essential because it aligns our portfolio with the best potential opportunities while managing risk. The optimized weights are then recorded for the rebalance date. Following this, we apply these weights to the returns of the chosen assets until the next rebalance. If we're at the last rebalancing date, we capture all subsequent data. The result of this process is stored in a data frame that contains the weights for each rebalance date and a series that captures the portfolio returns over time. It's important to be mindful of the assumptions made during the optimization, such as the stability of relationships between asset returns and the accuracy of our assumptions regarding future performance. Moving forward, the next cell will likely build on these back-tested returns, perhaps analyzing their performance metrics or visualizing the results to assess overall effectiveness. Cell 7. In this cell, we're diving into two main tasks. First, examining which stocks are held in the portfolio, and second, calculating performance statistics to evaluate our investment strategy. This dual focus is essential because it gives us insight into our stock allocation while also assessing how well these investments are performing. Initially, we assess how many stocks are actually held in the portfolio by determining which values in WHIST are significant, beyond a small threshold. By summing across the data, we can pinpoint the average number of holdings, which is key for understanding diversification. If that average is too low, it could mean we're overly concentrated in just a few assets, which can increase risk. Next, we also visually check the last 3 records in our weight history, offering a snapshot of any recent changes in asset allocation and helping illuminate trends over time. This step is more than just a routine check. It sets the stage for reviewing our investment strategy's responsiveness. Transitioning to performance metrics, we define a function to calculate important statistics like annual return, annual volatility, and the Sharpe ratio. These metrics are essential for understanding how effectively our portfolio generates returns in relation to its risk. The maximum drawdown statistic, which measures the largest peak-to-trough decline, adds a critical dimension to our risk assessment. To provide a benchmark for our performance, we compute an equal weighted average for the Dow 30. By gathering these statistics for both our portfolio and the benchmark, we can juxtapose our results, helping clarify how well we're doing compared to a standard market approach. These insights will guide our adjustments and fine-tuning in upcoming analyses. Looking ahead, the next cell will likely delve deeper into refining our strategy based on these performance metrics, perhaps setting the stage for further optimization or risk management. With a clearer understanding of our current standing, we're better equipped to make informed decisions in the future. Cell 8. In this cell, we're visualizing cumulative returns to better understand the performance of our investment strategies over time. This is essential because cumulative returns provide insight into how well our portfolio has performed compared to a baseline, like an equal-weighted Dow 30 index. We're starting off by calculating cumulative returns for both our portfolio and the equal-weighted benchmark. The calculation takes each return, adds one, and then computes the cumulative product. This method ensures that we're effectively modeling how an initial investment grows over time, accounting for the effect of compounding. As we fill any missing values with zero, we prevent disruptions in our cumulative calculations, maintaining a smooth trajectory in our results. Next, we visualize these cumulative returns using Plotly, a library that allows for dynamic and interactive graphs. Two distinct traces are plotted on this graph, one for our portfolio, labeled PGD Top K, and the other for the equal-weighted Dow 30, helping us clearly differentiate between the two strategies. The layout settings enhance our graph's clarity and usability by adjusting dimensions and hover features, ensuring we can easily track the performance at different time points. It's important to keep in mind that while the resulting chart provides a compelling visual comparison, there are assumptions underlying our analysis, such as consistent reinvestment of returns and ignoring any transaction costs that might influence realistic performance. As you interpret this information, be cautious of these simplifications. They can significantly affect your insights. As we look forward to the next cell, we're set to dive deeper into the interpretation of these cumulative returns, possibly analyzing risk-adjusted measures or drawing insights that inform future investment strategies. This next step will help us truly grasp what these numbers mean in the context of our overall financial goals. Cell 9. In this cell, we're diving into the concept of drawdowns, which helps us analyze the largest peak-to-trough declines in portfolio values. Understanding drawdowns is crucial for assessing the risk of an investment, as they can indicate how much a portfolio might lose from its highest point before recovering. The function defined here takes a return series as input and computes the drawdown for that series. The logic centers around calculating the cumulative product of the returns to obtain the portfolio value over time, and then measuring how far the value has fallen from its historical peak. Specifically, the function uses the cumulative maximum of the series to determine these drawdowns, effectively showing how much value has been lost relative to the highest value reached. Once we apply this function to both our portfolio and the equal-weighted Dow 30 returns, we create two separate series, one representing the drawdown for our portfolio and another for the Dow 30. The next step involves visualizing these drawdowns using a line graph. By plotting these series, we can easily compare how the drawdowns of our portfolio stack up against a benchmark. As we proceed, we determine the layout of the graph, ensuring elements like titles and axes are well labeled for clarity. Using consistent formatting helps make the chart more legible and engaging. This visualization not only highlights the differences in drawdown behavior between the two series, but also provides immediate insight into the risk associated with our investment strategy. In the next cell, we'll likely explore the implications of these drawdowns further, examining strategies to mitigate risk or optimize returns based on what we've learned from this analysis. This will deepen our understanding of how drawdowns interact with different investment approaches. Cell 10. In this cell, we're creating a heat map that visually represents the top stock holdings over the past 3 years, which is crucial for understanding how these investments have evolved over time. By using this heat map, investors can quickly identify trends in their portfolio allocations and spot any significant shifts in weightings that might warrant further analysis. The workflow kicks off by calculating the average weights of each stock held, which allows us to determine the top 15 holdings. This is done by sorting the mean weights in descending order and selecting the top results. Once we have our key stocks identified, we retrieve the last 36 months of data for these holdings, effectively focusing on the most recent months while ensuring we have a robust time frame for analysis. Next, we utilize Plotly Express to generate the heat map, setting the visual parameters like aspect ratio and title to ensure clarity and engagement. Each axis is labeled appropriately, with the x-axis indicating the rebalance dates and the y-axis showcasing the ticker symbols of the stocks. The color scale will represent the weight of each stock, enabling an intuitive understanding of how each position has shifted over time. It's important to note that we assume the data is cleaned and structured properly, as any irregularities could skew the visualizations. A common pitfall might be overlooking how recent market dynamics could influence these holdings, so awareness of external factors is crucial. As we wrap up this analysis, the heat map serves as a compelling visual tool that provides insights into portfolio adjustments and strategic planning. Looking ahead, the next cell will likely build on these insights, perhaps focusing on how these holdings compare to market indices or exploring performance metrics in greater depth. Cell 11. In this cell, we're diving into two important metrics: the Herfindahl-Hirschman Index, or HHI, which measures portfolio concentration, and turnover, which assesses the changes in portfolio allocations over time. These metrics are crucial for understanding not just how concentrated a portfolio is, but also how actively it's being managed. First, we calculate the HHI by squaring the weights of each asset in the portfolio at each point in time, and then summing these squares across the portfolio. This result gives us a single value that reflects how concentrated the portfolio is. An HHI of 1 signifies total concentration in a single asset, while a lower value indicates a more diverse distribution. This allows portfolio managers to assess risk, as a higher concentration often correlates with increased vulnerability to asset-specific downturns. Next, we look at turnover, which captures the degree of change in weights during rebalances by measuring the absolute changes in weights for each asset. By summing these absolute differences, we get an overall sense of how much the portfolio has shifted over the specified period. High turnover can imply active management, but it can also lead to increased trading costs, impacting overall portfolio performance. With these variables calculated, we visualize them with line graphs. The first graph illustrates how HHI evolves over time, providing insights into whether the portfolio is becoming more concentrated or more diversified. The second graph offers a similar view of turnover, allowing us to visualize active trading periods and understand how dynamically the portfolio is being managed. As we interpret these metrics, it's crucial to keep in mind the implications of both concentration and turnover on risk and performance. The next cell will likely build on these insights by incorporating further analysis or introducing additional metrics to deepen our evaluation of portfolio performance. This holistic approach will enhance our understanding of the portfolio's behavior and management strategy. Cell 12. In this cell, we're constructing a practical trade blotter that serves as a summary for our portfolio rebalancing, highlighting key metrics like target weight, previous weight, and the trade adjustments for each asset. This is an essential step in portfolio management, as it provides clarity on our trading decisions and helps ensure our allocations align with our investment strategy. The first thing we do is prepare the historical weights of the assets, aligning them with the available market data, which is crucial for accurate comparisons. Then, we calculate the previous weights by shifting our historical data, which allows us to determine how much each asset's weight has changed. This change, or delta weight, becomes a focal point for understanding how actively we're managing our portfolio. Next, we build our blotter by stacking the relevant weights and the calculated weight changes into a structured format. We also incorporate prices at the time of rebalancing, marrying our weight changes with the current market conditions. This dual layer provides a richer context, helping us visualize not just how much we've altered our positions, but also how those changes interact with market valuations. As we proceed, we introduce a capital figure, which allows us to calculate the dollar value of both the target and previous weights, as well as the corresponding number of shares we hold or intend to purchase. This adds another layer of depth by converting abstract weights into tangible numbers that are easier to interpret financially. To ensure the purity of the data, we filter the blotter to retain only those trades that are significant, essentially those that have a measurable impact, either through a change in weight or by holding the asset itself. This cleaning step is vital, as it helps prevent clutter from insignificant adjustments that do not influence our trading strategy. Finally, we wrap up the blotter with a rounded display format for easier viewing, making it clear and comprehensible. There's also an optional export functionality, which allows us to save this valuable information for future reference or reporting. As we look to the next cell, we will likely delve deeper into analyzing the results from this blotter, perhaps exploring the implications of our trading decisions or how they relate to overall portfolio performance. This will help us not only evaluate our past actions, but also refine our strategies moving forward. Cell 13. In this cell, we assess the progress we've made so far in our financial modeling journey, focusing particularly on our portfolio optimization strategy. We've developed a framework that not only estimates key metrics like the mean return and the volatility of our asset returns from the previous year, but also employs a custom gradient descent method to refine our portfolio selection. This step is crucial because it allows us to shift our attention toward generating an optimized portfolio of stocks. A key part of this process involves selecting only the top-performing K stocks, ensuring that our investment strategy remains both concentrated and deliberate. By projecting our solution to keep only these K stocks, we aim to maximize potential gains while containing risk. As we hold this selected portfolio over the next month, we will closely monitor its performance against a benchmark, specifically an equal weight portfolio, which serves as a baseline for evaluating our strategy's effectiveness. One crucial aspect to keep in mind is the assumption that the stocks we've selected will continue to perform as expected in the short term, a caveat that introduces some level of unpredictability in the financial markets. Navigating this river of market volatility requires a keen awareness of the underlying factors that influence stock performance. In the next cell, we will dive deeper into this performance tracking phase, focusing on how to quantitatively measure our portfolio's returns compared to the equal weight alternative. This will not only give us insights into the effectiveness of our selected strategy, but also prepare us for further iterations and enhancements in our investment approach. Cell 14. In this cell, we're diving into the mechanics of the projected gradient descent, or PGD, method, focusing on its application for portfolio optimization and determining which stocks to retain in a portfolio. This is crucial because effective stock selection can significantly impact overall investment performance. At each rebalance date, the PGD algorithm undertakes a series of steps to fine-tune the portfolio's weights. The first step involves calculating the gradient of the objective function with the current weight distribution. This gradient informs us about the direction we need to take to minimize our loss, essentially guiding us downhill on the loss landscape. Following this, We take a descent step based on those gradient calculations. However, a key feature of PGD is the projection step, which ensures that after adjusting the weights, we revert to a feasible set. This involves two important processes: the top K step and the simplex projection. In the top K step, we retain only the K largest weights, enforcing a rule about which stocks to hold and promoting a more concentrated portfolio. Following that, the simplex projection step rescales these K weights, ensuring they are non-negative and sum to 1, adhering to the constraints of being fully invested in long positions. Economically, this optimization balances two crucial factors. On one side, the risk term encourages diversification, pushing us away from over-concentrated positions in correlated stocks. On the other, the return term favors higher expected return stocks by adjusting weight assignments towards those identified names. Additionally, the top K projection introduces a degree of sparsity, compelling the algorithm to prioritize a select group of holdings rather than diffusing investments too thinly. As we progress to the next cell, we'll see how this meticulously refined portfolio can be evaluated and compared, providing insights on its performance in a real-world context. This transition into performance metrics will help us understand not just how the portfolio is constructed, but also how well it functions in practice.